All right, we are live, I think. Okay, there we go. Welcome everyone to episode 2 of the Almost Friday live stream. This is considered to be a live investing seminar, so join here if you're looking to get your finance questions answered every Friday at 12:30 p.m. For about a half hour before the markets close. I go live to answer your finance questions, to give you an update on what I think about the market, and to answer any finance questions that you have on your mind. These also get pre-recorded, so you can see them on my channel here under the live tab. You can also see that I'm live right now, and you can watch back and see the information that we covered in case you missed it. One important note for today is that the stock market is closed. It's currently Good Friday, so if you were to look up the S&P stock, you would see that this is the price from yesterday. So the market's not trading currently, but we're still going to do the show this week because I think there are a few important updates that we should talk about. So number one, I want to give you a look at my Bollinger Band indicator. In case you aren't familiar with this, you can check out this video here, how to time the dip perfectly. And I talk all about this indicator, but I'm going to give you an update on where it is. So here we have the S&P 500 ETF, SPY, on the 1-year chart with a 1-week candle. And I'm going to go in here to studies and find Bollinger Bands. Here we are. And we're going to make this a 52-week moving average with a 3 standard deviation down and a 3 standard deviation up. Let's make the middle line yellow, just do a little bit of color editing here. And by the way, if you're just joining, feel free to throw any questions you have in the chat related to finance, investing, and we'll get those answered for you on this call. So now that we have those Bollinger Bands in, let's see where we're at. Okay, not quite. 52, -3, and 3, right? There we go. Okay, so you can see a red line, a yellow line, and a green line, and this strategy helps us decide when we should get into the market. It is a quote-unquote buy the dip strategy, and the rationale of the strategy is that anytime the stock market closes below this green line, that's when it's time to buy into stocks. You can either reallocate from your existing bond position over to your stock position. If you have an existing stock position, you can take on more leverage. So you could go from SPY, which is just the normal S&P 500, to something like SSO, which is the S&P 500 times 2. So you'll see that over the year to date, obviously the market's been down, but the times 2 ETF is down 22% versus the normal one, which is down 10%. So if it were to go up 10%, you would make somewhere around double that. And so you can see here that we got close to it about a week ago, but we had that day where Trump announced that he was pausing tariffs for 90 days. We talked about that on the last episode and why I called BS on that. And we've since come down a little bit since then, but we're not quite to this buy the dip level yet. So that's an update on the Bollinger Band indicator. I'll be giving you an update every week and letting you know exactly when I'm going to be quote unquote buying the dip into this market. But for right now, that's the latest on this indicator. Next, I want to move on to some topics that came up over the week. So there was one comment that I had in my 401k video. It's this one right here. And someone pointed out, so in this video, just to give you some context, I talk about the best 401k investments for 2025. If you haven't seen this video, I highly recommend it, whether or not you have a 401k, because this is really important information to know, especially in this market. And in the video, I go through different asset allocations. So I talk about my 401k story. I go through picking your asset allocation, how to evaluate investments, because everyone's 401k is different, and then how to implement your portfolio and a common mistake that you should avoid. And in the video, I talk about an allocation of stocks compared to bonds and how virtually everyone should have some mix of both. You probably should not have 100% bonds or 100% stocks. But I had someone come into my comments and they made a good point. They said, look at any chart over the last 30 years. Bond allocations in bond funds like BND or BNDX are a terrible investment. You're better off in a CD or high yield savings account with FDIC insurance. And I responded to this person, but I thought it was an important point that I wanted to bring up for this live stream. They are absolutely right. If you were to look at a 10-year chart or a 30-year chart, bonds don't look very good. I don't think we can get that here on Google readily, but I will voice it over and I might make a full video on it in the future. So looks like we do have, this is the Vanguard Total Bond Market Index Fund, ticker BND. And you can see that over the last 10 years, back to 2015, the performance doesn't look very good, especially when compared to stocks. If I pull up the SPY, you can see that over the last 10 years, this has just done nothing but gone up. However, there are 10-year periods where the stock market doesn't really do much at all. You can see from 2000 to 2007, from peak to peak, the stock market was flat. And if we go even further, if you had invested in the stock market around the peak of 2000, which was not an uncommon thing to do back then, everyone thought the market was going to keep going up, you can see that over this 13-year period, stocks went up about 7% in total. So bonds aren't, my point here is that bonds aren't the only assets that don't have great returns over certain stretches of time, especially when you're picking a specific stretch like the last 10 years or the last 30 years. I don't want to bore you with the data, but I did look into it, and this will probably come in a future video. But going back to the early 1900s, if you look at the last 100 years of data, bonds and stocks actually don't perform all that differently. The long-term annual return for stocks over that period is around 9%, not adjusting for inflation, and the total return for bonds over that same period was around 6.5%. So we're talking a difference of about 2 to 2.5% per year. But that return, that extra return on stocks comes with a lot more volatility. In fact, it comes with about twice as much volatility. And so the point that I made here in the 401k video is that if you're saving for retirement, you don't want to have a 20, 30, or 40% loss in your net worth as you are nearing retirement in your portfolio. And that's why it is important to invest in something, in an asset like bonds, which have a lot less volatility. The second point that I want to make too is that when I presented this information in December 15th, 2024, I responded in the comments and I mentioned that every video I make, and this is something that I do to set myself apart from other creators here on YouTube, I make decisions based on the information that I have at the time. So looking forward, not looking backwards, because this commenter is talking about backwards looking data for the stock market and the bond market. Looking forwards, I felt that bonds were a reasonable investment compared to stocks. Obviously, I don't think anyone could have seen what was to come for this market in 2025, but given all the information that we had at the time, I've mentioned in previous videos that unemployment has been ticking upwards, inflation has been high, it's been sticky, and we are in an environment where rates are holding steady and may have to come down in the future, which is a benefit for bonds. In case you aren't aware, the value of bonds goes up when interest rates go down. So at that time in December, I made a call and said that, hey, I think bonds are a reasonable investment. And if you look at their performance year to date, that has turned out to be true. So year to date, this bond fund is up about 1%. And if I go back to that exact date, December 15, right here, they are about flat, 0.14%. If I look at the S&P 500 over that exact same time period, if I go back to December 15th or 16th, because I don't think we were trading on the 15th, if we go to here, the stock market has gone down 13.25%. So bonds have outperformed stocks recently by over 10% on a relative basis. And the reason that's important is that, like as I mentioned, this is based on the information that I had at the time in December of 2024. I also made it very clear, and this is the last point I'll make on this topic, which is I am not a stock guy or a bond guy. I am a total return person. I want my net worth and I want your net worth in your portfolio to outpace inflation. In fact, that's the primary reason that anyone invests in the first place, is that you can either put your money under the mattress and it will lose its value over time. You can put it in a savings account and it will go up a little bit, but you're still probably going to get outpaced by inflation. or you can invest it in the market and earn a return better than inflation. And ideally, you're doing so without taking a lot of risk, because it doesn't matter if your stocks are going up 10% per year. If you eventually get to a year where they go down 20 or 30 or 40%, you'll lose out on all that extra return. And if you weren't hedging yourself with something like bonds, then what's the point of trying to chase after these higher than average returns? So that is an important topic I wanted to cover for you, my viewers. And also just mention, you can interact with me in the comments here of my videos. I will always engage with you, mention, when you make a good point, and give that information to the rest of my viewers. So that was another point that I wanted to cover. I want to take a quick water break here, and if you have any questions, feel free to put them in the chat. I haven't seen anyone mention anything yet. No news is always good news, but if you feel free to throw them out there if you got them. If not, we will continue. All right, moving on. So the other big piece of news this week was that if I search Trump, Jerome Powell, in case you aren't aware, Jerome Powell is the Fed chairman of the Federal Reserve, and he is seen as the one person who has control over interest rates. Now, I could go at length about what the federal funds rate is, what interest rates are, but the big piece of news this last week is that Trump is considering firing Jerome Powell. This is important because Jerome Powell is seen as a net good for the market. He has his pros and his cons. There's some debate about that, but this is a very interesting story. If Trump were to fire the Fed chair, Jerome Powell, and replace him with someone that he prefers, this could cause a lot of volatility in the market. The reason I say that is because Jerome Powell is a known quantity. He's been the Fed chair for, it's Jerome Powell elected Fed chair quite a few years now. Looks like February 2018. So he is a known quantity for the markets. The market generally knows what Jerome Powell is going to do in terms of interest rates, and they generally know his view on the economy, and he's generally pretty what's considered dovish for the economy. He has a bias towards lowering interest rates. However, he's not lowering them right now, and I think that's for a good reason, but Trump is not happy about this. So Trump is looking into potentially firing Jerome Powell and replacing him with someone else. You might see a lot of content online speculating as to who Trump is going to replace Jerome Powell with and what the resulting impact is going to be on the market. I think that is a less interesting question than whether or not increasing or decreasing interest rates is a benefit for the economy, because it doesn't matter who the Fed chair is. The real question is, are they going to increase rates, leave them level, or decrease them? With Jerome Powell in place, he is probably more inclined to leave rates where they are, because in his view, the economy is still pretty healthy. If we look at the PCE inflation rate, which is the Federal Reserve's measure of inflation, it's around 2.5%. It's elevated, but in their view, it's not all that bad. You can see 2.5, 2.5, 2.6. Their goal is to keep this around 2%. The other metric that they look at is unemployment. And unemployment has also stayed pretty steady. It's around 4%. It's increased a little bit to 4.2%. It's kind of bouncing around between 3.9 and 4.2, and that is very low historically speaking. Let's see if we can find a chart here. You can see that it's low historically speaking. It is increasing a little bit, but it is still in a good spot where the Federal Reserve feels like they don't need to intervene in the economy. The economy will regulate itself. If interest rates were to go down for no reason, which may happen if Jerome Powell were replaced, because that is Trump's goal in replacing Jerome Powell or potentially replacing him, is to get interest rates lowered, then in the near term, that would decrease a lot of costs for consumers. You might see mortgage rates start to go down. You might see lending rates on various products like auto loans start to go down, but this will increase spending, and increased spending leads to increased inflation. In fact, we just had a period recently during the COVID bubble, quote unquote, where the Federal Reserve was perceived to have left rates too low for too long. In case you weren't aware, this was called the zero interest rate policy, or ZIRP economy. And there's a lot of discussion that goes on that this was a bad thing for the economy, that there was too much inflation, Valuations of companies were way too high. There were all kinds of asset bubbles that we're still dealing with. In fact, this may be why the stock market is as high as it is today. And if we were to lower interest rates from this level, that would potentially, likely, exacerbate that issue. So on the flip side, if we were to keep Jerome Powell in place, he'd probably keep interest rates where they are. He may even increase them, which may bring unemployment up even more. It may slow down our economy a little bit. But again, the whole goal of the Federal Reserve, they have something that's called a dual mandate. They focus on two metrics and two metrics only. And I showed them to you already. Those are unemployment rate, which is they want to keep it at a low, reasonable level. They don't want to keep it too low because then you have an economy that is too hot. And they want to keep inflation at or around 2%. And inflation is still stubbornly high. As I showed you earlier, it's been stuck around this 2.5% level. Now, I've talked to some people about this, and they'll mention, well, 2.5% isn't that high. But anyone who knows about compound interest knows that a 0.5% per year adds up to your wallets when it comes to your prices increasing. Additionally, a lot of folks forget that low inflation is not no inflation. So if we look at the price level, what happened, because I think a lot of folks forgot, is that prices increased around 10% during COVID. I'm trying to see if we can get a chart here. The index, where's the index level? Give me just a moment to find this. Is this? Yes, this is the index level. So and if we look at 5 years out, I guess, gosh, it's been so long since COVID. So here, this is the actual price level. So this isn't the percent inflation that you see that's quoted in the news all the time. This is the level of prices that we're getting that year over year growth from. So think of like a stock market index, but this is for the average price of goods that you pay. It's measured here in points. It's just as a reference number. This isn't like a dollar amount or anything like that. But what I want to show you here is that from 2021 all the way up to the middle of 2022, this was when we had this really big surge of inflation of like 7 to 8 to 9 to even up to close to 10% on some levels, which is almost unheard of for the American economy. And as a result, we saw the price level go from 260 all the way up to 300, which, if I'm doing the math in my head correctly, is around a 20% total increase. And after this, sure, we got inflation to come down from 10% down to 7 to 5 to 2.5%, but it's never gone negative, and the price level has continued to increase. So a lot of consumers, a lot of investors that I talk to, they sometimes have confusion. Well, I thought inflation was low, but everything's still so expensive. How does that make any sense? This is exactly why, because even though inflation has come down, it has not gone negative. Prices have not gone back down to where they were. They've just continued inflating at a lower rate. And this is what the Federal Reserve is really paying attention to, because if they were to lower interest rates, that would create more spending, right? If auto loans are cheaper, if mortgage loans are cheaper, you're going to end up spending more money. If your credit cards are cheaper as well, just on average, consumers will spend more money. When consumers spend more money, businesses think that's a good thing, and they raise their prices because there's more money coming in, there's more demand, so they raise their prices. And when they increase prices, that is an increase in inflation. And this can start to spiral out of control. You can see this sort of circle, this downward spiral, where when companies increase their prices and they make more money, they have more money to pay their employees. So their employees, who are the consumers, have more money to spend, and then they spend more money, the prices go up, and it just goes in the circle over and over again, which exacerbates inflation. So that is what Jerome Powell is trying to avoid. But if Trump were to fire him and replace him with someone who lowers interest rates, that could be perceived initially as a good thing for asset prices, but in the medium to long term is probably not a good idea for the economy. Andrew, good to see you in the chat. I appreciate the feedback. Looks like we got some more people coming in. So if you have any questions at all, I'm going to take another quick water break. Again, I've got about 10 minutes left for this stream. We do this every 30 minutes on Fridays before the market close. Obviously, the market's not open today for Good Friday. But if you got any questions about finance, investing, anything else on your mind, hit them in the chat. Otherwise, I'll just keep going for 10 more minutes. Okay, no news is good news. So there's one more topic that I want to talk to you about, and that is related to the crazy market action that we've had over the last month or so. Let me just get a chart here for you, and I want to look at the daily moves. Here we go. So here we've got 1 day moves in the stock market. Each of these bars is 1 day, and we had a sharp move downwards in the S&P 500. Then we had a single day where the stock market went up over 10%. And this brought me to a very interesting question that someone asked earlier this week. It was in a different setting, but they mentioned, hey, I feel behind in life and I have a small investment account. Should I be taking on more risk since I don't have that much to lose and am looking to catch up? So this goes out to anyone who has, I would call it, under $25,000 in their investable accounts. I'm not counting 401k. This is someone who has saved up maybe $1,000 or $5,000 or even $10,000, but they feel like they're behind, and they feel like in order to get to where they want to be, which may be a certain level of net worth, is maybe a certain amount of money that they have invested, they want to know if they should be taking on more risk to quote unquote catch up. This could involve investing in things like cryptocurrency. It could involve investing in options, or just putting all of your money in leverage ETFs with the hope of, instead of making 5 or 6 or 7% per year, instead making 15% per year. And I want to show you, just objectively speaking, why this is wrong. And I'm going to do so with a financial calculator, and we're going to do just a little bit of simple math. And what I want to show you is the difference. How do I want to phrase this? I want to show you how little your percentage return matters in reaching your first net worth goal. And I'm going to set that goal at $100,000. So let's say you feel behind. You have maybe $1,000 or $2,000 or $5,000 in the bank, and you want to reach a $100,000 net worth goal. So let's say you want to do this over a period of, let's call it 5 years. You want to do this pretty quickly. And let's say that you're starting with $2,000 in your investment account. And let's ignore any kind of savings or deposits for now. That's what would go here in this financial calculator. This would be how much you're saving per year. So let's say you're at $2,000 and you want to get to $100,000. Actually, let's do, how do I want to do this? Let's see what we get here for the future value. Payment needs to be numeric, 0. Okay, so if you're earning 6% a year at a $2,000, starting with $2,000, then you're only going to get to about $2,600. If we double this to 12% per year, which is an insane amount of return, you're only going to get to $3,500. But let's say that you have the same $600 return, but instead you're able to save an extra $1,000 per year. Now you're all the way up to $8,000. And so you can see that it's not really the percent return that you're making on your investments if you're trying to hit a certain net worth goal. It's about how much you can save. And there's this flawed logic that I see that a lot of creators will often perpetuate, and they'll often say something along the lines of, you can't save your way to retirement. You can't save your way to being a millionaire. That is, in my own words, BS. I'll leave the profanity out, but that's complete BS. I don't remember the exact source. Let's see if we can Google it. Savings, percent of savings to reach 100K. Let's see if someone has the number here. But the point that I want to drive home here is that when you're reaching a $100,000 net worth goal, around 80% of that is just going to be from saving money. It doesn't matter what your return is in the market, whether you're getting 5% per year or 10% per year, or even you're some kind of crazy crypto investor and you're making like 15 or 20% per year. Your 100,000 net worth goal is primarily going to be your ability to save money. So if you have an account If you're starting out late or you have a small account and you feel like you're behind and you're trying to catch up to this $100,000 goal, or you're trying to get to a certain amount of net worth, whether it's $1 million or $10 million, your goal should not be to take on as much risk as possible, which again, I don't understand where this logic comes from, and a lot of folks recommend it. You should not be taking on as much risk as possible. You should be trying to either increase your income as much as possible or increase your savings by decreasing your expenses or pursuing a side hustle. Because the big differentiator here is going to be whether you can save $500 or $1,000 a year or $2,000 a year or $5,000 a year, not whether or not you can make 6% per year in interest or 12% or anything like that. So that was an important point that I wanted to bring up that someone asked about this week. I know it's not intuitive. Everyone is always focused on picking the best investments, on making the best return, on trying to get 10%, 11%, 12% on their money. Sometimes this involves investing in high dividend stocks or leveraged ETFs or investing in crypto or something like that. But if you're trying to get to that 100,000 or more net worth goal, it's primarily going to come from your savings. And I don't think I have it with me here, but if I were to give you an exact target, just the only number you need to know, I would say aim to save around $7,000 per year, which I think works out to somewhere around $600 a month, give or take, which in my opinion should be doable for most American households. So we are coming up on about 30 minutes. The stream's going to end in about 3 minutes. I wanted to give y'all a chance to ask any more questions you had, any reactions, feedback to what you've seen so far. If not, again, no news is good news. I'm going to take a quick little water break and then we'll sign off for the week. All right, we got one question right at the finish line from Mauricio. How do you feel crypto will perform against stocks and bonds? This was a topic that came up last week from one of my viewers named Masood, which was really good. I haven't seen him here on this live stream, but hopefully he catches the recording and sees my take on crypto. And I'll give you my 2-minute take. Crypto is an enigma. I'll call it an enigma, because it is not an asset in the same way that other assets are good investments. A good asset to invest in provides cash flow. So think of a business that generates profits, or even a stock that pays dividends, or a rental property that pays money. If it pays you cash flow at some point in the future, you can ascribe a value to it. Bitcoin is not that. Bitcoin, I would bucket more as a collectible. It is a digital asset that has demand, and that demand creates value. And you're only able to make a return from Bitcoin as long as you have faith that everyone tomorrow will still want Bitcoin. The issue with Bitcoin and with crypto is that there is a very probable chance that at some point in the future, no one's going to want cryptocurrency. And I'll pull up a Bitcoin chart here just so we can see what we're talking about. And you can see a lot of folks will look at this chart and be like, hey, what should I do with crypto? Like, it's made 18,000% all time. Like, should I be investing in crypto? And my answer is I would just be very cautious. I personally am not currently invested in crypto. I've dabbled in some strategies investing. The strategy that I always used that actually did kind of work. It's just not something that this isn't an asset that I'm an expert on. But I always figured whenever Bitcoin is making really big headlines, then I'm just gonna back away and not buy, because that's typically when it spikes and then it kind of fades back down from there. It kind of goes through these like fad cycles, I'll call it. So I think around this time in 2021, once I start to see Bitcoin dropping out of headlines, and usually you see this, like this may be one of those times, but you'll see headlines going like, oh, Bitcoin's down like 30% this year, and is this finally the year where it blows up? if I were to invest in Bitcoin, that's when I would set like a $10 or $25 per week deposit into my Cash App and start buying, like accumulating Bitcoin. And then once I see the cycle like repeat itself and Bitcoin's like all over the headlines again, that's when I would start getting out of Bitcoin. I would not, it's at the end of the day, it's a personal decision. If this is a level of risk that you want to take for this long-term return, I would say, in my view, no more than at most 10% of your portfolio in Bitcoin. I would feel much more comfortable at 5%. If you think Bitcoin is the next gold, I got something else that I could sell you, and it's called gold. If you think Bitcoin's the next gold, just buy gold. And the issue with Bitcoin as a replacement for gold is that it's based on the power grid. And so if you're ever in a situation where you lose electricity, you lose all the value that you had in your Bitcoin. And then the other thing with gold is that it's useful. It's a conductor. It's used for conducting electricity in a lot of components. It's also used as jewelry, and it can be, you can transact with gold. It has value to it, even though it's not bringing you in cash flow. So that's my view on crypto. I wouldn't make it more than 5 or 10% of a portfolio. I personally would not invest in it. I think that there are comparable assets that can get you the same outcome without having to invest in crypto. It's too volatile for me, and it has a higher likelihood of going to zero over the long term than anything else that I'm investing in. So that's my view on crypto. I know there are other people out there that are more bullish on it than me, but when I think about my goal of investing for outpacing inflation, growing my net worth over the long term, sure, Bitcoin has a really attractive return since its inception, but it's not the risk and return profile that I'm looking for. It's too volatile. It can swing very wildly. We saw here it went from a high of, over a course of a year, it went down 65%. And that's just not something that's appropriate for my portfolio. But if you feel that it's appropriate for your portfolio, if you have faith that Bitcoin will have some sort of utility aside from being a digital collectible in the future, if you think that there will continue to be demand tomorrow, next week, next year, 5 years from now, 10 years from now, there will still be demand for whatever cryptocurrency you're investing in, then it could be appropriate for you. With that being said, I need to sign off for today. We've gone over by a couple minutes, but thank you for joining, and make sure to stay tuned for next week on episode 3 of the Almost Friday podcast. I don't have a closing bell to ring for you because the market's not closing today. Otherwise, my app here would start dinging. But with that being said, I will see you all next week. Thanks so much.